Well, we're back at it with yet another monthly update on this stock portfolio as I try to reach $100,000 in portfolio value. And we actually had a respectfully green month at nearly an 8% gain. I am filming this on Sunday, and this video should go out on a Tuesday, so we'll see what happens in the day between there. But it's been an overall very positive month in what's been a very negative year. If we go to do I dare go on the 1 year view? Let's go ahead and do it. Oof, yeah, down 30% on the year on a money weighted return basis, which is actually a bigger loss on a money weighted basis, but the actual absolute loss is bigger in the 1 year view than the all time view. That's just how money weighting works. It depends on when you put the money in and when you make the actual investment. So that's why that's a little weird. But in the 1 month view, things are nice and green. It was largely spearheaded by Turtle Beach being up 30% on the month. And we also had some pretty big rallies really across the market. We had some positive, if you want to call it that, inflation news, where the October CPI read a bit lower than people were expecting, and that caused the markets to go crazy because I guess that's the light at the end of the tunnel. We're almost out of this, but we'll see what actually happens. But many of my holdings did quite well on that macro news. And now's the time that I'm going to be getting rid of what I would call my first value investing stock pick, where I was really trying to look at the intrinsic value of the stock based on its underlying cash flows and what I might have thought future cash flows might be, and then discounting it based on my discount rate and doing a whole discounted cash flow analysis on the stock. It was the first time I really had done that when I kind of converted into the value investing school when it comes to stocks. I feel like I already kind of had it for real estate, so it just kind of clicked when I realized, oh, when you're buying a stock, you're buying an underlying business, and that business has an intrinsic value that's often separate from the price. At least that is the argument. That's really the value investing school. And really the first one I ever did was CVS when this portfolio was much smaller. Not a ton smaller in the grand scheme of things, but definitely a lot smaller than where we're at now, just because we were talking about a $1,000 investment being pretty relevant at that time. And those $1,000 are about the $1,100 I put into CVS, almost doubled up to $2,000. So it ended up being great. I've had some bigger losers in the meantime. It's been actually one of my best winners on a percentage basis. So it's kind of funny that my very first one actually worked out really well, but I felt like it ran up in price so quickly and I really just stopped kind of following the stock after that. Maybe that's a mistake, but it was kind of my first one. Glad it worked well, but like I said, I really have not been following CVS in quite some time, and I think it's just better just to consolidate, have one less thing to worry about, and roll it into some other stocks in the meantime. When you delete a slice on M1 Finance, it will automatically rebalance it into whatever is underweighted based on your target allocation. So I kind of tinkered with it here, so it would go to certain stocks that I want it to go to. So it's going to be going mainly to Facebook and then Sleep Number, or Facebook, I keep calling it that. It's actually Meta Platforms. And then I'm also doing a smaller purchase of Turtle Beach because I'm also selling some of my gold mining holdings right here. So that's the GDXJ and the GDX. So those are the two index funds for the gold mining industry. Really an industry that I don't follow too closely as well. So just kind of trimming down the stuff that I'm not really following and putting it into the things that I am following more closely, because I'm really trying to sort of conserve my energy, because my focus is pretty much in another place right now. Because as of today, I'm in some pretty serious negotiations with the seller for a small business here in Houston. That's really been my number one priority when it comes to investing. My number one priority in general, I guess, is my career when it comes to finances, at least. Family, friends, all that, that's important too. But it's been kind of career. Then after that, it's been looking for a small business. And then after that, it's kind of stocks and real estate and all that. I'm not really looking actively for new stocks to add very much. And I'm definitely not looking for new real estate unless it's part of an underlying small business. So my efforts have really been going towards that. So in the meantime, I feel like it makes sense to sort of trim down my holdings or not really trim them down, but consolidate them more into the things that I am following more closely, and even just leaving some cash potentially. I probably won't do that because I have a good amount of debt. So the cash probably should go either towards debt, or I guess I could invest it as well. Or then again, there's always value to having some extra reserves when you do have debt. So it makes sense to hold cash. I do have cash reserves for my other debts when it comes to my real estate holdings, but maybe it makes sense to raise some more cash if I'm getting into this small business venture while I build up the reserves from there. Nothing's actually concrete yet, but I'll definitely let you know what happens there. But I think my plan moving forward with the portfolio is to continue doing more of that. Trimming down holdings. I think the next in line would be getting rid of my gold miner ETFs. Actually, if you go to the 1 month view, they've done quite well. Very, very well, actually. About almost a 20% gain, 19% gain or so on the month. Gold did quite well, especially after the inflation news. Pretty much everything did well, like I said. So those really rebounded on that. And I would be selling these at a loss, so it would sort of offset the gains I have over here on CVS. So from a tax perspective, you could call that efficient. I only decided to lose money in those ETFs so I could get that tax write-off. That's what we like to call 4D chess. But anyways, I've really made a philosophical shift when it comes to investing in these relatively liquid assets that are highly traded by tons of people all around the world. I am viewing these more as defense in that, yeah, you can make great returns and you can certainly build a fortune over the long term, especially when you invest in these assets and even in the short term when you get lucky with things. But I view stocks as defense, and I really want to focus more energy on the offensive side of things. That's creating new income, maybe buying a business that has a lot of cash flow potential, way more cash flow potential than rental property perhaps, or even many of these companies that might be doing great, but they're maybe trading at really high multiples compared to a private business. And when you get the private business, you get to do whatever you want with that cash flow. That's for better or for worse, of course. But I think in my current position, it makes more sense to focus a lot more on offense rather than defense. You obviously can disagree. I'm not recommending that you do that, but I do think it's worth thinking about because I think a lot of people do put the cart before the horse and that they're really tinkering with their $10,000, $20,000, $30,000 portfolio, which even if it doubles, is that really going to move the needle? Probably not. Maybe it would. If it does, then obviously do whatever you want. But in my case, if this portfolio doubled in the next year, that would be really nice, but would it really move the needle? Probably not. Yes, I'd be $78,000 on paper richer, but not only does that seem very unlikely to happen, but I think I could use the same efforts that I'm spending towards managing my stocks, managing my real estate, or really looking for stocks and looking for real estate, and instead looking for something with a lot more cash flow potential. So that's really why I'm doing what I'm doing. Plus, I think both investing in and then managing a small business would make me a much better investor outside of that as well, when looking at public companies, when looking at a piece of real estate, when figuring out how to manage any of these assets. I think it'll be really good experience for pretty much anything after that. That said, I'll still be keeping tabs on what's going on in the portfolio. And if there's a great opportunity that I still think is worth investing in heavily, then obviously I'll do it. But I'd expect a pretty small portion of my income to be going towards defense for a pretty significant period of time. If I have money coming in that I want to be more defensive with, it's probably going to go towards debt pay down rather than investing. Though we'll see how I do when I actually have the money in my hands, because it's very tempting to go and spend it on new investments when I could be paying down debt or whatever it is. Really, it'll probably be a mix of both of those things. A little bit of debt pay down here, a little bit of investing here into this portfolio and other things. Whatever the case, I'm just trying to move forward. Love to get your thoughts in the comments below. Otherwise, like, subscribe, all that great stuff. And until next time, take care.